Hi folks, welcome to this video on one of your textbook questions. So by this time you've probably had a chance to review the questions so you know it's there, and let's begin to make the journal entries. So in the first part of the question it says that on January the 1st the company issued 5,000 preferred shares for $12 a share. So we're creating new equity in the business. Equity accounts are increased with credits. So the specific equity account we're going to credit is preferred shares, and we're doing our deal for cash, so the investor is giving us cash. So we debit the asset cash and credit the shareholders' equity account preferred shares. And for how much? 60,000. So in this case, we had to calculate the credit and debit amounts by multiplying the number of shares being issued by $12 a share. Now, since we know that this is the company's first year of operations, and if we've read ahead, we know we have to do the equity section of the balance sheet, it's a really good idea for us to start tracking the number of shares and the amount that we got when we issued the shares. So in our case, what I'm doing down here for calculations is I have a separate section for preferred shares and a separate section for common. And I put in the date, the number of shares issued under preferred, and how we calculated the value. So I've got a column for shares and for dollars. If you would like, you can certainly do your dollar calculations using a T account, up to you, but I've just chosen to use a table format at this point. All right down here. So now, what happens on February the 5th? Well, again, we issued common shares, and in this case it says that they're 15,000 common, but it says we issued them for a total of $126,000. So we didn't have to do any calculation here, but we did need to know that we were receiving cash and we were issuing more equity. So we're going to credit the specific equity account, which is common shares, and debit cash for $126,000. And then again, we're starting a little section down here for common shares just to track, and we're saying on February the 5th we issued 15,000 shares and we got $126,000. On the 20th, what did we do? We issued shares, but we didn't get cash for them. We received services from the organizers of the corporation. So remember, that's an organization cost or an expense. So we debit organization expense and we credit common shares for $28,800. Now we know in that particular example, it says that we issued 3,000 shares based on the value of the services we received, or the value of the shares, I should say, and that's $28,800. So we credit our common shares for $28,800 and debit, in this case, not cash, but organization expense. Now we are going to look at our May 15th transaction. And at that date, what happened? Well, we issued not only preferred, but also common shares. So our shares were issued sort of in a bundle to the investors. And what did we issue? We issued preferred shares, 12,000 of them at $13.20 a share. So our preferred share equity increased, so we credit that account for $158,400. And we also credit our common shares because we're issuing more equity, but by how much? The number of common shares we issued times the market value of those shares, $9.60, for $192,000. So again, we're going to go down here, and on May 15th, you notice in the preferred share tracking and the common share tracking, we have some items. 12,000 shares for $158,400. Again, we get our number from here, $158,400. And again, May 15th, 20,000 shares were issued and we got $192,000, which we have in our entry. Notice we're not tracking balance sheet accounts here like cash because we don't have to do a full balance sheet. We're only tracking our equity accounts because we have to do the equity section as well as the statement of changes in equity. So now, last thing we're going to do here, it says on December 31st, the income summary account was closed and it had a debit balance of $329,000. Well, don't forget what we said. If your income summary account has a debit balance, that means that you must have made a loss that year. You didn't make profit or income, you had a loss. Because when you have a debit balance in your income summary, that means the expenses that you closed out to the income summary in total are bigger than the revenues you closed out to the income summary. So whenever your income summary has a debit balance, that means that you have expenses in excess of revenues, so you have a loss. So what we learned is that to close out that income summary account or set it to zero, if you have a debit balance, you need to credit it. So we credit the income summary for $329,000, and in our case, we're going to debit or reduce retained earnings by $329,000. Now, because this company was a startup, we had no opening balance and retained earnings. So our ending retained earnings amount is in fact called a deficit. So we debit retained earnings to move the loss into retained earnings. But you'll see in the equity section of the balance sheet, we're going to refer to it as a deficit. All right. So now, when we total the number of common preferred shares we issued and the total amount of equity we received or we issued when we issued our 17,000 shares, and we see in our common shares, we do a similar calculation. We issued 38,000 shares, and the common share equity that was created was 346,800. These numbers that I've got here in red, the 218,400, which is the dollar value of preferred shares issued, and the 346,800, which is the dollar value of common shares issued, those are going on to the equity section of the balance sheet, along with the number of shares issued and outstanding for preferred, which is 17,000, and the number of shares issued and outstanding for common, which is 38,000. So let's begin constructing some of our statements. So the new part I added here is to do a statement of changes in equity for the current year. So you notice that at the beginning of the year, before anything was issued, or as we say, at December 31st, 2016, we had no balances here, right? But don't forget, during the year, I guess I should put that in there, make a little edit here just to align our totals. You'll see here, however, we do have preferred shares that were issued. That was the total dollar value of the equity that was created when the preferred shares were issued during 2017. It didn't affect our common shares. It doesn't affect our retained earnings. But you see, it does affect the total equity created. Similarly, when we're looking at the value of the common shares we issued, we can get that from up here when we did our tracking. And we also know that, we'll just try and align this a little bit better for you. Total equity created here through the common share issue in 2017 was 346,800. Notice we had a loss, which brings down our retained earnings from zero to a more negative number, which is 329,000 deficit. All right. So now these final numbers, when we add our columns, these are the numbers that are going to appear on the balance sheet in terms of the dollar values. So that's why we say you always do a statement of changes in equity before you do the equity section of the balance sheet. So now when we do the equity section of the balance sheet, you can see here we've listed under the contributed capital section, which is part of the shareholders' equity section of the balance sheet. So in other words, the shareholders' equity section of the balance sheet has two subsections: contributed capital and our deficit, which is our negative retained earnings. So what makes up contributed capital? Preferred shares. Now don't forget, if you have preferred shares issued, they always go before common. Notice now in our question, they told us what the preferred share dividend was. The preferred share dividend is always stated next to the account preferred shares in the equity section of the balance sheet, if in fact you have preferred shares. In our case, we do. They stated the dividend was $1.50. And again, as part of the required, we might as well get to that now, that $1.50 is the dividend entitlement to preferred shareholders once a dividend is declared. It's always stated on a per share basis, and unless it's stated otherwise, that $1.50 is an annual dividend. So we stated the $1.50 annual preferred share dividend. The number of shares we are authorized to issue, which in this case it's limited to 50,000 for our preferreds, and the fact that we issued 17,000, which we got from our tracking up here, right? So now we take our equity again from the statement of changes in equity, so we have 218,400. We also see from our common shares, We are authorized to issue $300,000. That was given to us in the question. Notice we don't have anything to do, we don't state anything with respect to the dividend because common shareholders by and large do not get a stated dividend. And we know that of that $300,000 they're authorized to issue, $38,000 have already been issued. And again, we know that because we tracked it up here when we were issuing shares. So if we look again at our statement of changes in equity, we can see that that's $346,800. So the total contributed capital is $565,200. If we now include, as part of our shareholders' equity section, our deficit, right? It's negative, or it's a deficit, $329,000, which is deducted from your total contributed capital to give a total shareholders' equity of $236,200, which is right here. So we've already discussed C, so let's look at calculating the average issue price per preferred share and per common share. The reason I make you do this is because when we start talking about repurchasing or buying back shares, a company is going to buy them back at the market value, but they remove them from their books at the average price paid by investors when those shares were issued. So we need to get you used to doing an average issue price calculation to get you ready for what's coming up in our course. So in our case, all we do is we take the total amount of equity that was received when the preferred shares were issued, divided by the number of shares that we issued, which was 17,000. So to 2 decimal places, we see that an average preferred share investors gave us $12.85 per share. Similarly with the common, we take the total common share equity created, which we can see from the equity section of our balance sheet is $346,800, and divide it by the number of shares, common shares, that we issued in exchange for the common share equity created, $346,800, and we're going to get $9.13 per share as the average issue price. So this concludes our video for this particular question. I hope you found it helpful.